Friends, one hypothetical question. Let's assume you work for a small Bangalore based startup company. They are holding an event in New Delhi next week and have selected a few people to attend the event. Now, your name is also on the selection list. Management team has informed that they would pay only 8,000 rupees for one-sided journey, and it was up to the people to make the travel arrangements on their own, which means 8,000 for one side, 8,000 for another side. Now you have two options. First option is flight. The flight costs around 6,000 rupees and it takes close to 3 hours to reach Delhi from Bangalore. So you can start either directly on Monday morning or by Sunday evening to reach the place. The second option is train. A third tier AC coach train costs around 1,500 rupees, but it will take the 1.5 day or little more to reach Delhi from Bangalore. So in this case, you need to start either on Friday night or Saturday morning to attend the event on Monday, right? However, you can save 4,500 rupees by avoiding the flight journey. The question is, which one you choose? Train or flight? If your answer is flight, then I will do one thing, friends. I will share my opinion in the end, okay? Now, the important question is it really necessary to monitor the screen continuously during the market hours to manage the option trades? It need not be, not necessarily. You can take trade in options with just 10-15 minutes of homework before the market opens and 5 minutes during the market hours to execute or punch the trades, and you can hold the trade until the end of the week or end of the month to make some profits. In this video, we will learn that trick. So without wasting much time, let's start. Before I proceed, I want to set the right expectation, friends, because most people in trading fail because their expectation in terms of ROI itself is very, very huge. So, if you expect 20 to 25% returns in one trade within one day or within a week, this is not the right strategy for you. And you can stop watching this video right now itself. It saves your a lot of time, right? Because time is also very important. So this strategy is only helpful for the people who aim to earn 2 to 3% per month, but you don't have to log in and check every day, right? So if you are lucky, you may earn little extra also, but it all depends upon many factors. So in simple terms, if your expectation is very, very huge, like 20%, 25% per month, then this is not the right strategy. You can stop watching video right now itself, okay? So now options buying or option selling. So this is a pure option selling strategy. So whenever I make a video on option selling, many people comment or come back, they saying, why a video on option selling, why not a video on options buying? Friends, I have made some videos on options buying also. So if you're really interested to know options buying video, I will give the link in the description. You can watch that video, but this video is all about option selling, okay? Let me very, very clear from the beginning itself. Now, whenever I say this, again, many people comment, why option selling? Why not options buying? See, friends, every concept has its own advantages and its own disadvantages. So, options buying demands a lot of action and involvement from the individual in the live market, okay, in the live market. So, if you have time, it is fine. But there are many people who don't get time to check in the live market, but still they aim to make some profits in trading. So also in options buying, direction clarity is needed, right? Where the price will go, that is very, very important in options buying. At the same time, price should go in that direction to give you profits, right? Suppose you have a clarity about the direction, but the price will not go in that direction, you will not make money as an option buyer, right? So the direction clarity, where the price will go by the expiry, is needed, and price should go there to make money as an option buyer, right? This is very clear. Whereas in option selling, I don't have to know where the price will go. Direction clarity 100% is not needed. All I need to know is where the price will not go. For example, a car is driving, is going in Bangalore to Chennai. So in option buying, you should know it is going to Chennai, but they might take a deviation from Chennai also, right? So in that case, as an option buyer, you lose money. But if you take option selling, a car is going from Bangalore to Chennai, I can say it is not going to Hyderabad, it is not going to Delhi, it is not going to Mumbai, because it is in the opposite direction. In that way, you can make money in option selling. So this video is all about option selling, okay? Now, uh, there is no doubt hedging reduces your profits, but I always prefer to take option selling trade with hedge instead of naked selling. Okay, because hedging provides long-term consistency and safety in trading, as it removes unlimited loss scenario. Right? Because when you take in naked option selling, whether you sell call option or you sell put option, it automatically comes with unlimited loss scenario, because if the price moves in that opposite direction, there is a possibility. I'm not saying it will move in the opposite direction in every trade, but there is a possibility, and anything can happen in the market, right? That's always an headache in the market, because this is positional trade. We carry the trades. It's not an intraday trade, right? So there is always a possibility. In overnight, anything can happen. Market can change like anything, right? So I always prefer hedging. And many people say, whenever I say hedging, they say it reduces the returns. In fact, if you use hedge properly in a smart manner, it increases the ROI further, okay, compared to naked option selling. So I will explain all these things in detail in the next few slides, okay? Now let's assume this is ICICI Bank daily chart. For some reason you are bullish on ICICI Bank stock. So you decide to sell put option. I'm saying why hedging is important. I wanted to illustrate an example for that. Okay. So ICICI Bank, for some reason you are bullish on this stock. Now assume that right now I'm recording on 10th Feb or 11th Feb this video. So February end is the last monthly expiry, right? So you decide to sell 1200 put option at 5.15 to collect some premium. Now today is 11th Feb, so maybe 28th or 27th Feb is the last monthly expiry of this month. So you decide to sell the monthly option of this ICICI Bank 1200 put option to collect some premium. So let's see how it looks on payoff graph. Okay, this is the payoff graph. So this is 1200 PE. You sold 27th Feb, because 27th Feb is the expiry day on this particular month. You collected 5.15 premium. Okay, so this is the probability of the profit. For example, probability of the profit is 87.52. You will, the maximum profit is, always don't look at this number. This number is always discouraging. Always look at the percentage wise, friends. Okay, so it gives you 3.23%. Everything looks fine except this, right? Undefined loss scenario. So maximum loss is undefined, because the price can come to zero, right? If something happens, theoretically, practically it may not happen, but there is a possibility, right? There is a possibility of huge loss. So that's why it shows maximum loss undefined. So now imagine how the market will react on the next day if there is a scandal like Satyam in ICICI Bank. And I'm just taking an example, okay? So assume overnight, today night, there is a scandal news broke out in ICICI Bank. What can happen? Forget about slippage tomorrow morning. You will be lucky if you can exit the trade itself at any available price, right? It means you might have to exit 1200, this put option sold at 5.15 to any price, maybe 500, maybe 800, maybe 1000 also. So this one trade can wipe out your entire capital, because this is a naked selling, there is no hedging for it, right? Now, if you even if you do short straddle or short strangle, many people think it is we are selling both CE and PE and we are safe. That is not the case, friends, because if the price shows directional move in one direction, because DK from the other end will not be able to compensate the increase in premium from directional move, okay? Because one side the price will move, right? The premium starts increasing like anything, but on the other side, the value will come down, but after a while it cannot compensate the increase of this premium, right? It will be very, very huge. So even if you think you play short straddle, short strangle, it may not be very safe if the price moves in one direction very quickly, okay? So this is the same ICICI trade, but with an additional leg, okay? Additional leg of this. Okay, so I have bought 1100 PE at 0.45. Okay, this is just an additional leg. So what it does is this removes the unlimited loss or maximum loss scenario. So and even if the price reaches zero, I will lose only around this much, right? 66,500. Don't assume or don't think we always lose this much of money, because it happens only in the extreme scenarios if the price moves drastically. Okay, but without a hedge, your loss would have been more, right? It's like you can't even imagine, it can wipe out your entire capital. Okay, so if you have an edge, what happens is this the maximum loss will be limited at least. Okay, if you notice, it also increases the ROI rate. Earlier it was, with the naked selling, it was very less actually. Okay, it is only 3.23. See here, just adding an additional leg, it increases the ROI as well. Okay, that's why you should be very very I mean, that's why I'd say hedging is really, really important. And you can compare one by one. Okay. So this is, for example, without an hedge. This is with an hedge. Okay. So you can see possibility of profit. It's almost same, right? 87%, 87.52%. Okay. Both are same. Now ROI. Look at the ROI. So ROI without hedging is 3.23. ROI with hedging is 5.47, right? So hedging always increases ROI. And look at the maximum loss. Here it's undefined, right? Maximum loss is undefined. Anything can happen. Whereas here the maximum loss is at least defined. That's very important. Now you can check whether this maximum loss scenario will come under your portfolio risk management rules or not. Okay, that's where you get a clarity, right? Next, the margin requirement. You can see here one point, you need close to 1,11,564 rupees to sell one lot. You can see here 64,000. With 64,000 you can execute these two lots, right? So which is better? This is always better with hedging, right? Because in hedging, number one advantage is it removes or get rid of maximum loss scenario. I mean, unlimited loss scenario. You the maximum loss is defined actually. That is the number one advantage. Number second advantage is it increases the ROI rate. If you use it smartly, it increases the ROI. And number third is it reduces the margin requirement, right? So you can take little extra portion. Okay, so my final conclusion is edging is mandatory in options trading, especially in option selling, to limit losses and protect capital from unexpected market moves. Okay, it ensures controlled risk and helps traders to trade with the confidence. That's the most beauty or the most important aspect of hedging actually. Now, this is very very important topic, friends. Listen to me very very carefully. You should always remember, only entry and exit decides the fate of your trade, irrespective of your educational qualification, reputation in the market, or experience in the market, right? See, this is ICICI Bank chart. Do you think this is the best time to sell call options? For example, this current month, the call option. Or I will show one more trade. For example, this is LNT chart. Okay, this is LNT daily chart. Now assume you have two options. Either you need to sell call option in ICICI Bank or in this LNT chart. Which one you choose? Okay, you can see this is ICICI Bank. You whether you will sell call option in ICICI Bank or you will sell call option in LNT. Okay, I choose ICICI Bank, the previous one, over LNT. Do you know why? The reason is very, very simple, friends. You can see this is LNT, this is ICICI Bank. See, there is a support zone for LNT at this level, right? So if I sell call option at this point of time, you never know. Maybe today or maybe tomorrow, immediately it might give a bounce, right? The big players who bought at this level here and here also, you can see the big buying here also, they might pitch in. When I take the trade now, and the price starts to move in my opposite direction, right? Whereas if you see in ICICI Bank, there are no big players at this level. Big players might come at this level, the previous swing low, or maybe at this level. Okay, so if I sell call option now, definitely big buyers will not pitch in the next few days, and the time decay of the next few days will give a cushion to me. For example, assume if I sold at 10 rupees, so after 1 week or after 10 days, it will come down to 3 rupees, 4 rupees. So I will have a enough cushion. Okay, because if I sell at here at 10 rupees, if big players pitched in, immediately it will come to 30, 40 rupees, right? Because of the big move, or maybe 15 rupees or maybe 20 rupees. So even the loss will become very huge, right? I mean, suddenly it increases a lot. So Always, that's why I say entry and exit is very very important. So your entry price should it should have an edge, a proper edge. Exit also, I will cover the exit in the end, but entry also, that's very very crucial. So always ensure there is no big buying zone or a big support during the time of your entry. Okay, it should come like this. There should not be any big buying zone or big support or very crucial support level, so while you taking the trade. Okay, so my final conclusion is, you know enter an option selling trade where opposite forces are very weak. Okay, so this way the next few days time decay, the time decay or theta works in your favor, increasing the profits. Okay, now, few example. Okay, this is Titan. Again, not a good place to initiate selling of call option, right? Because it is at the right support zone. Okay, previous swing low support. So this is not the right place to initiate call selling, right? Call option selling. So one more example. Uh, you know. This is State Bank of India. Once again, it is at a proper support zone, right? So this is not the right place to initiate call option selling, right? Okay, what is the strategy? The strategy is the most important part. So I will share the strategy bit by bit. Okay, my only request to you friends is, don't draw any conclusion whenever I say one point about the strategy. Don't draw conclusion in your mind saying, this is useless or this is highly useful, whether it is negative or positive. I'm saying don't draw any conclusion. Okay, so keep an open mind, watch the video till the end, try to observe all the components of the strategy, then now connect the dots and then you make an opinion. If you think it is bad, it is bad, it's okay, it's fine. You mention in the comment, I take it okay, happily. Even if it is positive, you mention in the comment, I'll take it happily. But what pains is, or what is not so good is, they watch up to some video, up to some component of the video, so only one part of the video, and they develop an opinion and they will write a comment, or they will say something that is, this is not really good. Okay, now, first thing first, this strategy involves selling monthly options in stock. Okay, I'll repeat once again. This strategy involves selling monthly options in stocks. Okay, I know time decay is good in weekly options, but we don't have weekly options for stocks in India, right? So we sell only monthly options. Okay, this strategy, number one point, we sell only monthly call options in India. Okay, as part of this strategy. Now, the second part, we sell only call options and not put option. I'll repeat once again. We sell only call option but not put option. Okay, because price goes upside in stairs. Okay, it will go very slowly upside, but while coming down, it comes like this, right? So why to take unnecessary risk by selling put option? Okay, so two directional like short straddle, short strangle is not needed because anything can happen, right? Put option, there is high risk. Why to take risk? We sell only call option because price goes up very slowly, so we get at least that time or cushion to manage our trades, or if you initiate good our trades in a good place, so immediately the time decay of next few days immediately will start showing in the profits. Okay, that's second part. So first option, we sell only monthly option. Second option, we sell only call option. Okay, that's that second point. The third point is, look for rejection or weakness in the market. Okay, so selling call option after price rejection. Okay, now assume this is a resistance, price comes here and now it tests here, but there is a big rejection, like a big bearish engulfing or big bearish Morobozo. So whenever you see this, we will initiate the time decay, because with time decay in our favor, the option premium drops and leading to the profits. Okay, so that's, we always look for rejection. The third point is, we look for rejection or weakness to initiate the trade. Okay, see, this is an example. ITC chart. Do you agree this is a resistance, previous swing high also, and resistance area also, right? Can you see in this candle, it went up very big, but can you see this is selling, right? Okay, it's a clear rejection saying the price will not go from here. Okay, even if you can't initiate the call option selling on that particular day itself, the green candle day, it's okay. Even if you wait the next day, see here, next day you got the red candle, right? This is a bearish candle. So after the completion of this candle, red candle, you can always initiate the trade, because first point we sell monthly option, second point we sell only call option, third point we look for a rejection at a resistance zone to initiate our short trade, which means selling of the call option. So once you get this, this is quite clear, the price will not go up from here, high probability. Okay, next, this is one more example. For example, this is ONGC chart. You can see the trend is down, right? The trend is downtrend. This is very, very clear. And you can see once again, there is a proper resistance line, and price is showing resistance. This is a bearish engulfing, right? There is a big bearish engulfing candle at the resistance, downtrend. Everything is in our favor, right? So we can look for selling call option at this point of time, okay? On the next day. So this is one more example. This is power grid. Once again, the trend is down, very clear, right? Once again, there is a resistance, and once again, there is a big bearish engulfing candle, right? So there is a high possibility, price will go down. So listen to me very carefully. If in option buying, let's say if you are an option buyer, if you buy put option, price should move immediately like this to make profit, right? But if in option selling, if you sell call option, there is no need price should go down, right? If it stays sideways also, you make money. If it stays sideways and if it expires, you make money. Look at this candle, there is a clear rejection, right? The trend is down, there is a rejection at the trend line, there is a bearish engulfing. So after this, price cannot go on the next day immediately, right? Or next, at least next few days, it cannot go. It will consolidate, right? So that consolidation itself will give us the money, right? Okay, so now check the probability. Okay, so there are many tools available in the market. So before executing, we check all these criterias before the market hours on the previous day. So on the previous day, we decide to take a trade on the next day. So we can check the probability. There is an option called as Obstra. Okay, for example, this is Bajaj Auto chart. Let's say this is Bajaj Auto chart. Trend is down, very clear. So now it is showing weakness. If you draw a resistance trend line like this, it showed rejection. Now you want to take a short trade with Bajaj Auto. Okay. So the price is somewhere around 8764. Okay. At the time of recording this video, the price is 8764. So you can see you decide to sell how much? This one 94 CECE, okay, close to around 700 points, strike points away. You decide to sell the call option, right? See here, this is maybe it is trading around 27 rupees, and as an hedge you will buy 9800 CE. Always remember, friends, your hedge should come around hedging leg should come around 20 to 25% of the premium compared to the selling leg. Okay, see here 8, it's close to 25%, 25%, right? 25 to 30%. Okay, in that way it is good to cover the any losses, right? Because I've seen many people who take an hedge leg. For example, if the main leg is like 27 rupees, they opt for an hedge leg like 0.5 paisa, 0.25 paisa, only to get the margin benefits. Okay, so don't do that kind of mistake, because in case of any uh, if the price moves unlimited in the opposite direction, your hedging leg cannot compensate further. There is a high possibility, but in this case, your hedging leg can compensate. Okay, so always check your hedging leg will be at least 20 to 25% of your the main selling leg. Okay, that's very important. You can see, always check this probability of profit should be above 90%. Okay, so only in this case, it is comfortable. If it is less than 90, I suggest to avoid it, because you can compromise with percentage, ROI percentage. There is no problem, because option selling, the probability of profit should be higher. Okay, always give priority to this next to the ROI. Okay, so you can compensate a little bit with ROI. Instead of 3.47%, you can go for 2.5%, 2%, even 1.5%, even 1% is fine. But always ensure the probability of profit is greater than 90%. Okay, that's the most important thing. And see here, it was 90%, right? I see here, I just pushed 100 points. Okay, I just pushed by 100 points. Instead of 9400, I pushed to 9500. Same here. See, the probability went to 93.25, right? See, it came down a little bit, 2.60. Previous was 3.47. The ROI came little down when I pushed the strike price by 100 points, but still okay. I would say this is a better deal. Okay, so my suggestion is always ensure the probability of profit is more than 90%. That's always there. But if possible, if the ROI is good, you can look for this. Okay, this is a better, right? 93.25% probability is very good. Okay, there is a high possibility of price. You pocketing this points profit 2.60% profit, right? Okay, always look. One thing is ensure always look for probability of profit is above 90%. So this is an tool from Opstra Define Edge. If you go to Opstra Define Edge on Google, okay, go to Strategy Builder, you can add these two leg, you will be able to get the clarity. Okay. So there are many more, like Sensible. You can also use Sensible. You can also use. There are many more. Okay, you can use any tool. This you can check online for free. Okay. Now one more. Okay, Tata Steel chart, Tata Steel daily chart. Now the price is here. Okay, so today is February 11th. The price is here. Tell me what is the probability of price reaching 150 in 18 days? So if you remember, the Nifty is in a downtrend now. Tata Steel is also in a downtrend. Exactly, it is at resistance. If you draw a resistance line like this, it is at resistance and it is showing a weakness at resistance. Okay, now from here, what is the possibility or probability of price reaching 150 in 18 days? Not 18 trading days, 18 total days. Okay, very less probability, right? Now let's see, if you sell this, for example, 150 call option, what is the scenario? See here, if you sell 150 call option and if you buy 160 call option as an hedging leg, see there is a possibility of 96.75%. Once again, I'm saying don't go for this number, friends. This number might be deceiving. You might think only 825. Okay, but you should always give importance to ROI. ROI is very important, because if you have 10 lakh rupees, this is a different ball game. Okay, because it increases here by 10 times, right? Okay, so my suggestion is always give priority and importance to ROI. Okay, see here, the probability of profit is 96.75%. ROI in 1.84 in 18 days is very good. It's a very good thing actually. Capital requirement is only this much. Okay. Now, one more example, BPCL chart. So once again, Nifty is in downtrend. The BPCL is in downtrend. Again, BPCL took a resistance at a resistance zone. What is the possibility or probability of price reaching 285 in 18 days, friends? Very less, right? So you can sell easily 285 call option this month end, and you can pocket some money. This is the strategy, overall strategy I was explaining. Okay, so we sell monthly option, we sell only call option, not the put option. Third option, we look for a best entry point. Okay, it should not be at the immediate support zone or important support zone. Okay, and the best place is whenever it shows the rejection at a resistance zone. Okay, so that's where we sell actually. Now we will see, if you sell this 285 CE BPCL, okay, and opt for a hedging leg at 290 CE, you can see the probability of profit is 93.2%. This is good. You can also check ROI. ROI is 1.33%. This is also good. Margin is 23. So even if 20,371. So if you have just like 1 lakh, maybe 1,000, 2,000, you can easily generate this 1.33%, right? 270 into maybe 5. Okay, you will generate that money. Okay, it's like 1,300 something. No, that's a really very easy money in 18 days, right? 1.33% in 18 days is really good actually. Okay, so okay, this is the overall strategy, but I wanted to mention certain precautions. Okay, that's very very important. So precaution number one is liquidity. Okay, so liquidity is crucial in stock market. I mean stock options selling, because low liquidity can lead to high slippage and wide bid-ask spreads, making it hard to enter or exit your trades. Okay, now selling option in liquid stock ensures better pricing. It's a quick execution, smoother execution, lower trading cost, everything, right? So now the question is, how do we check the slippage? Many people ask me that question. The answer is very simple. Whatever the strike price you wanted to trade or any stock you wanted to trade, go to at the money option, maybe call option, maybe put option. You open it to 5-minute chat. Okay, this is very important. 5-minute chat. So go to 5-minute chat, open 5-minute chat, observe this. See, there is no slippage, right? There is no slippage. There is no huge gaps. There is no dots, right? So whenever you see the dots, the one small line, so like a minus line, it indicates there is no trading activity, which means there were no buyers, there were no sellers. That is a lack of liquidity. Okay, so my point is very simple. Whenever you finalize a stock to take a trade on the next day, so go to your broker site, open at the money strike price, maybe call option, maybe put option. If you see continuous data like this, it means the stock has a good liquidity. There is no problem with the liquidity. Okay. Second, if you get like this, see the dots. Say once again, this is also 5 minute chart. Friends, this is a at the money strike price. Okay. This is a company from F&O listed in NSE. It is at the money. Okay. Can you imagine at the money itself is looking like this? Can you imagine what will happen if you go for out of the money? You can't even imagine the liquidity, right? This is a very big company actually. Okay, so my point is very very simple. To know the liquidity, open the strike price, either call option, put option, ATM strike price of that particular stock, and go to 5 minute chart and check this. If there are no liquidity issues like this, I suggest not to take the trade in that particular stock. Okay, so look for some other stock. Okay? That's very very important. So this is how you should look for liquidity. So first precaution, always prefer stocks with good liquidity. Okay, that's first precaution. Now, always use limit order, friends, because using limit orders in stock option selling helps to avoid high slippage and ensures better entry prices. Okay, market orders can fill at any unfavorable prices, okay, any available price, especially in low liquidity stocks, impacting overall profitability. For example, let's say you take a trade in a stock which has less liquidity. The current market price is 100. Okay, you wanted to sell it at 100, you wanted to buy it 100. If you give market order, it might execute at 105, maybe 106. So in that way, automatically while taking an entry itself, you lose the edge, right? Because 5 rupees extra, you should not look at 5 rupee, it should look like in percent times 5%. Okay, so this thing will happen, can happen in option selling. So I should be very very careful. So always use limit order. Let's say there is 100, current market price is 100, you wanted to buy at 100, you put an limit buy order at 101. So it will be executed within 101, 100 to 101, but not at 105, not at any price above 101. Okay, so in that way you ensure the execution is very very smooth. So even if the stock is liquid, always use the limit order. Okay, some brokers, they have made mandated the limit order to buy the stock option, but always better to ensure, irrespective of the broker, it is always better to use limit order to execute trades. Okay, this always avoids the slippage part. Number third, avoid always avoid high beta stocks. What happens with high beta stocks is, you know generally high beta stocks are very very good for options buying. And because if the nifty moves 1%, these high beta stocks will move 1%, 3% or 2%. Okay, so this is good for options buying, but not for option selling. Okay, because if the price moves 1% against your direction, it will move 3%. If the nifty moves against 1% in your against direction, opposite direction, the stock will move 3% in the opposite direction, right? You lose money, right? So high beta stocks are not good for option selling, because they move up and down too fast. Okay, so these stocks react strongly to market news, making price movements unpredictable. Okay, if the price moves too much in one direction, the sold option can become very risky and causes big losses. Okay, so that's why I always suggest avoiding selling high beta stocks call option. Okay, some of the notable high beta stocks in Indian market are maybe Titan, Reliance, State Bank of India, Axis Bank, ICICI Bank. These are all HDFC Bank. So these are Infosys, these are TCS. These are all high beta stocks. Okay, so avoid these high beta stocks. Okay, that's the third precaution you should take. Now, the fourth option is, don't go against a strong uptrend or big players. So, if you see the presence of big players in a stock, so don't go against them, because selling call option is like going against the big players, right? Don't do that mistake, okay? Because I'll take a simple example. You can see this is a Maruti Suzuki. This is a recent chart, okay? You might think, see, it is a taking rejection here, there is a rejection. You might think, I will sell call option somewhere here. But observe here, who created this big candle compared to the, see, for example, this is close to 2 months activity. Okay, the 2 month range in one candle they came. See here, who involved here? Big people, right? Close to 3 4 months activity in one or two candle, they push the price, right? Who involved here? Who involved here? Definitely big buyers, right? Not sellers, big buyers. So whenever you sell a call option here, it is like going against the big buyers. Don't do that kind of mistake. Okay, don't be such a stupid. Okay, don't commit such kind of mistakes. Okay, selling call option here is like a going against these big buyers. Okay, don't do that kind of mistake. Okay, so the second option is, second example is Bajaj Finance. Okay, observe this. So right now Nifty is falling, but Bajaj Finance is going upside. And also observe who involved in this candle. Big buyers, right? Who involved in this scandal? Big buyers. Who involved in this scandal? Definitely big buyer, right? So definitely for any reason, don't think to sell call option here. Okay. So the fourth rule is very simple. Don't go against a big trend or big buyers. Okay. So our strong uptrend. If the stock shows the presence of big buyers like this or a strong uptrend, don't aim to sell that call option. Okay. This is the fourth precaution you should take. Okay. And this one also, one more example, Bharti Airtel. So it is showing a breakout. Okay. So I mean, it might go into sideways, it might come back, but it is a breakout structure, right? It is a showing breakout structure. So whenever price shows the breakout structure, also I suggest to stay away from it and don't go for it. Okay. Now, opposite move. What do we do if there is a opposite move? F- Compared to our direction. Okay, so always remember the market can move against your trade at any point of time. There is a possibility. That's why I always say only entry and exit decide the fate of your trade. Okay, so entry we have already covered. We will see the rejection at a strong resistance zone, then we will take the trade. Okay, so that entry will be safer. That's always there. But exit is also very important. So exit in most of the trades is nothing but we close at zero, right? Because we are selling call option, it will come to zero at the end of the month, and it is zero. But if the price moves in the opposite direction and if you are not prepared for it, the losses can be significant. So it is important to have an exit plan also in the worst case of scenario. Okay. Now, there is a simple strategy. Okay, I suggest a simple adjustment strategy, which involves buying one additional leg to compensate or to reduce the losses from the selling the main leg. Okay, now let's say, so this is the current market price. This is the selling leg, 1300 CE is the selling leg. This is the edge leg, 1500 CE. Now, if the price moves here, that's where the risk comes into the picture, right? Whenever the price comes to here, so this becomes ATM 1300. If the price moves above this, this becomes ITM. That's where the risk starts. It's the premium of this starts going, right? So okay, if this move comes near this expire, I mean, for example, this move comes near this 1300, near the expiry. Very, for example, tomorrow's expiry, it move came here. So it means you've already pocketed the premium. The premium would be maybe very, very close to zero or maybe very less, maybe 2 rupees, 3 rupees. So in that case, you already pocketed the premium. Okay. So in that case, book the profit, whatever it may be little percent, 0.5% or 0.75% or maybe 1%, 1.5%, whatever it may be. Book the profit and close the trade. Okay, come out of it. That's the most safest thing to do. Okay, that's the one thing. Second thing is, let's say if this move comes, you know, a few days after the before the expiry, but after few days after entry. Okay, in that case, you already pocketed close to 50 60% of the premium. But still, whatever the premium compared to the bought premium, let's say let's say you bought at 10 rupees. Now the premium is 12 rupees, the price is here. Okay, so I'm just taking an example. Okay, so here when the current market price is here, you sold this 1300 call option at 10 rupees after few days. Okay, that's why I always say don't buy at the important support zone. Okay, because support zone buyers can pitch in and immediately it can come here. That's why I always say, you know, don't go for it. Okay, that gives the cushion. Okay, so now assume you bought at 10 rupees. You sold at 10 rupees, this strike price 1300 CE, and now the price came here. Now the same strike price is current, the market price is 12 rupees, 2 rupees extra, which means you are going through loss, right? 2 rupees loss. Now your biggest fear is what if the price goes above this level? Okay, so in this case also you can book 2 rupees loss, come out of it, that's a different story. Suppose if you want to continue, you might think there is a big rejection or strong resistance here, it will go back. So then what you can do is you can buy this 1400 call option. So what happens is, if the suppose if the price comes down here and comes below this, then it's okay. This will be the 12 becomes 0 once again, and this is very less compared to this premium, right? So maybe 7 rupees or 8 rupees, again this will become 0, that's okay. But if the price moves above this, any you know the drastic move of this, the loss from this move will be compensated from this leg. This is also called as, I think it's a butterfly strategy. Okay, so it is compensated from this leg. Okay, so in that way you can manage the trade. So once again, you you check, you take one or two, you take one or two paper trades, observe it. So always ensure whenever the price moves in the opposite direction, uh, check a leg like this. What will happen, observe one or two trade like this. Only if you get confident, then only you can start to take the trade. Okay, that's the second point. And the third point is, suppose move comes very quickly, maybe 2 3 days, there's a less probability, because if you recall, that's why I suggested not to initiate the position near strong support zone, right? So because we get a cushion of 4 5 days, no days of time decay, if you don't initiate the trade near the support zone. So by any chance, if that kind of move comes, so buying in additional, like anywhere above this 1300 till 1500 is the only option to reduce the loss, or you can close your trade. Both you can do anything, but I always suggest you should have a proper exit plan. If the price goes against your direction, that clarity you should always have it. You should not think what to do when the price comes here, because when the price comes here, uh, you know uh, probably looking at the losses, you may not be able to think rationally. Okay, so you should always have an exit plan while taking the entry itself. That's why I always say entry and exit decides the fate of your trade. I hope this is very clear. Now the question is, how do we go to Bangalore to Delhi, right? See, now there is no wrong or there is no right, friends. See, some people might opt to go for a train by paying 1500, and they save maybe around 5 6,000 rupees, because 8,000 is the management they give as a transport allowance. Let's say you use 1500, let's say another 500 expense, let's say you save 6,000 rupees. So some people will feel happy because they saved 6,000 rupees, and they are happy to uh, uh, lose the 2 days, Saturday and Sunday, while doing the journey, because in train journey it requires 1.5 day to reach from Bangalore to New Delhi, right? So they are okay to compensate or go for a train journey of 1.5 day, and they save 6,000 rupees. So this is one category of people. The second category of people is, they don't want to waste Saturday and Sunday on journey, and they prefer a flight journey, and they're happy to pay 6,000 rupees. Okay, they're happy to pay 6,000, they're happy to lose all the 8,000 rupees for that journey, but they want to save, they want to save that Saturday and Sunday 2 days. Now the first category of people who went in train, they might think these people are fools. Okay, but that is not the case, friends. You should always remember, uh, what happens is, many people or most people, they measure the price only in terms of money. Okay, but that's not correct always. I will give you a simple example. Let's say your mom or dad is admitted to the hospital. You need 1 lakh rupees within 24 hours. Okay, you need 1 lakh rupees within 24 hours. So the price is not only money here, 1 lakh rupees, but there is an additional constraint within 24 hours. That is also a price, because if you get 1 lakh rupees after 48 hours, or after 3 days, or after 1 week, it's of no use, right? Because there is no use, right? That's why if you don't pay the EMI in bank EMI, it will charge the fine, right? Even if you pay day after that, after the EMI due date, it will put that fine. There is a cost involved. So that's why I always say you should measure the price in terms of money and in terms of time. Both are important. Money is also important, time is also important. So first category of people who traveled in train, they measured the price only in terms of money. 6,000, 1,500. They measured in terms of money. The second category of people who decided to travel in flight, they measured the price in terms of both money and time. 2 days, they don't want to lose 2 days in train. Okay, so and for them they are okay to spend 6,000 or 8,000 rupees, 6,000 also. Okay, so in another words, these guys who decide to travel in the flight, okay, they had the ability to earn that 6,000 rupees or 8,000 rupees in 2 days. They have the ability. That's why they opt for train. For them, those 2 days are very, very important compared to the 6,000 rupees savings, right? So always measure the price in terms of money as well as time, because both are very, very important. Okay, so that's all, friends. I hope this video is really, really helpful. If yes, please like the content. You can share this video with your subscribers, and if you don't have any clarity, you can comment below. See you in the next video with another useful content. Until then, see you. Tata. Bye bye.